This is one of the weirdest, most eclectic weekly leaderboards we've seen all year. Look at some of these products. You probably haven't even heard of some of these. That's broad market. There's junk bonds. Japan, what's that doing there? Mid caps. Then you got XLItes industrials. This is a buffer ETF. That's an interesting line, but that really has nothing to do with sentiment. Bonds. USMV, that's probably the only thing that you probably recognize. That's been on the leaderboard all year. This is the #1 flow getter. Let's look at outflows, though, for more of a clue into what's going on, because obviously last week was bullish. This week, not so much. In fact, more bearish, because look, IVV and the Qs are at the top. That's tech and S&P, energy. You've got some mid caps in there and momentum. So I'd say it's leaning bearish, but in order to really solve this, we created two new indices that we're going to show to you right now called Risk On and Risk Off. Risk On tracks ETFs that are like offensive factors and sectors, and Risk Off tracks defensive sectors and factors. And you can see here, Risk Off in October is kind of winning. It's been a lot of volatility to get there, but Risk Off is starting to take over Risk On. But really, the bigger takeaway is look at the sort of tug of war going on between Risk On and Risk Off all year, and the contrast between last year when Risk Off was clearly the trend. This year, every time Risk On gets going, Risk Off comes back. Scarlet, this is the theme of the year. Nothing is really taking over. There is no regime right now.
All right, so no clear narrative in the markets. Let's bring in Eddy Elfenbein. He is portfolio manager of the AdvisorShares Focused Equity ETF. And we want to welcome Annie Massa, who covers the asset management industry for Bloomberg News. Eddy, it doesn't appear that there's any clear consensus on whether to tilt growth or defensive. What's your take on leadership in a stock market that's near record highs and clearly in a late cycle economy?
Yeah, it's interesting. Nobody has sort of wanted to jump in front of the pack. And as soon as you think somebody does, they pull back. But I do think there is a case for cyclicals to gain momentum going into this year and into next year. Obviously, we got the Federal Reserve on the side cutting rates. Who knows how low they'll go? They may take a pause. But the key I'm looking at is the housing market. That has shown a remarkable level of resiliency. And while the housing market isn't the most important for the entire economy, it's the most important for the direction of the economy. And there are so many knock-on effects within construction, within consumer spending. So that's what I'm keeping an eye on, and that's why I think that we'll see consumers a lead towards a lot of the cyclicals, and maybe the defensive names will pull back on a relative strength basis.
Of course, we're also trying to sift through earnings and find out what the themes are there, Annie. It's a big earnings week, about a fifth of the S&P 500 coming out with results this whole period. The big banks surprised to the upside. The industrials, we're seeing that the drag of the trade war is really taking its toll. Tech earnings are picking up as well. What ETFs are you watching here in tech land to be most in play?
Yes, so tech has really been one of the better performing sectors this year. You see funds like the Qs and IGM up about 25% year to date. So as we move into earnings season, we've already had Netflix report pretty strong results, and you have some more FANG stocks like Apple and Facebook reporting next week. So investors will look for signs of trade war drag, and that'll be something they'll be watching.
All right, Eddy, let's dig into your ETF a little bit to get your take on the market, because you pick stocks, but it's rules, right? That's what your ETF is. Normally, when I think of stock picking ETFs, I see Amazon and Apple at the top, like especially mutual funds too. When you look at yours, I see stocks like Moody's, Sherwin-Williams, Hershey.
No tech names.
Yeah, really some interesting names on there. Why are they at the top of this fund of yours?
Basically, it's old school stock picking. I really like these companies. I think they have good moats. I like the management. I like their market niche, and also I like the price. As I think it's not what a computer spits out. It's old school stock picking, and my supporters and friends, we go through 10 Qs and 10 Ks and try to find out the best values.
All right, so due diligence the old-fashioned way. Now, your fund, CWS, is the first and only ETF with performance-linked fees as well. And this is something that Wall Street veteran Peter Krause, formerly of AllianceBernstein, has talked about. He said, the business has to be restructured so we can regain the trust of the clients. To do that, you have to align the fee structure with the client. I think the market will force the industry to change. Eddy, explain how your performance-linked fees work.
Sure. Basically, skin in the game. The better the fund does, the better it is for me. And if we trail, investors get a discount. So it's 75 basis point is sort of the neutral rate. And then on a trailing 12-month basis, our benchmark is the S&P 500. And basically, if we beat the market then I get a little bonus, and I have this year. But if we fall short, as we have, it has happened before, then investors get a little bit of savings.
How much of a bonus? How much of a savings?
I get there's several different tiers. I don't have it with me, but it's roughly 50 to 1 for every 50 basis points that we beat the benchmark, not just a profit, but beating the benchmark will go to me. That's my bonus.
And Annie, talk about how Peter Krause's model, he's actually a company based on this. How is that different from that?
Sure. So Aperture has this idea that it's similar to Eddy's idea to link performance and fees for its products. So the idea there is really to kind of shake up the traditional model where you're paying a fixed rate on assets under management and align your performance with the fees that you're charging for investors.
A novel idea, if I've ever heard of one. Annie, this goes hand in hand partly with discount brokerages tripping over each other to offer commission-free trades. Everyone's looking for ways to save investors money and to get them to put more assets with them. B of A is now joining the crowd?
That's right. Merrill Edge was the latest broker to jump into this fray of charging zero commissions. And of course, they're following Schwab, TD Ameritrade, E-Trade, which all did similar cutting to zero of commission fees earlier this month. So it's basically a trend where investors are increasingly paying nothing to trade, and these companies have to come up with a way to make up the revenue somewhere else.
Eddy, I have to imagine you're just loving this, right? This is just a gift on your front door, right? So explain how this might benefit indies or smaller ETFs like yourself.
Well, I guess, this really is a true turning point within Wall Street. It's a huge victory for individual investors. And also it goes at, I think, sometimes the closed priesthood of the very large investment bank. It really is the barbarians are at the gate. We're breaking through. And this is it gives more visibility to smaller ETFs, different ways of investing, and ways that I think, frankly, are more investor friendly. I think this is a huge victory for the individual investor.